Hi, in this video I'm going to review the MACD indicator and show you how it should be used. Now, the MACD is one of the most common indicators out there across different markets. It's very simple to use. It is also very simple to abuse. We'll talk about that more as we run through the indicator itself. The purpose is that you come away with a method to actually get a signal to enter or exit a market. So what I'm showing you here is the MACD on the bottom here in its simplest form, and obviously price, and I've also put two moving averages on here. Before I talk about those, let's just look at the figures down the bottom here. This is a momentum oscillating indicator as opposed to just a straightforward oscillating indicator. So its aim is to show you when there's momentum in the move and when that momentum's then lacking. So it shows you the momentum of the move, whether it's strong or weak. It's derived from the two moving averages, the 12 and 26 exponential moving averages. The 12 is the faster moving average there in yellow, and the purple one is the 26. Now, what the two moving averages basically show you, or the principle, is as the faster moving average breaks above the slower moving average, that the momentum and it's basically a signal that the move is becoming bullish. So it's a bullish signal, and vice versa. When it crosses down through the 26 moving average, the faster moving average crosses the slower moving average, it suggests that it's a potential sell signal. So this is just any old market, Euro Canadian. It's quite a nice trendy type market, and on a 4-hourly it shows the picture absolutely perfectly. It's current time, there's no hidden factors there or anything. So the further the two moving averages actually gain, as you see, when the slower moving average actually pushes through and starts moving, the acceleration is quicker, and the moving average will show the difference quicker than the slower moving average, obviously, because of the way it's calculated. So you'll see this momentum pushing, effectively being shown as momentum. The further away it is, the more that you'll see the MACD going up. In fact, if it's currently sitting, the two moving averages sitting around about 18 pips away from one another. The maximum they pushed up here is around about 38 pips. It dropped down here the other side by about 40 pips. You can see the distance between those moving averages down here. So that's the basis of the MACD. Shorter moving average over the longer is a bullish signal. Shortish moving average crossing below the slower moving average is a bearish signal. Now, I haven't put it on yet, and I'll put it on now. There is a signal line. Let me just pop that on here. So there is a signal line which also is shown on here. This is just the MACD all on its own here, and there's a relationship between these two. This is a smooth 9-period moving average, and this is the MACD itself. Again, when it crosses, it's seen as more of a bullish potential, and when it crosses to the downside, so when the MACD crosses below its signal line, it's seen as a bearish signal. Now, they're very aggressive signals. I'll say that right now. Very aggressive signal in terms of it can end up crossing back and forth. And I don't know if we've got an example here. It's sort of here. It's probably crossed backwards and forwards a bit here, suggesting it's gone bearish, going bullish, etc. So you can be chopped up using it in that way. Now, finally, there's a histogram, and the histogram element, let me just bring this on. The histogram literally is a measure of the distance between the smoothing moving average and the MACD itself. So what it shows you is the momentum. So as it's getting stronger overall, the momentum's growing here, or further apart. Now it's not totally correlated to the actual 2 moving averages above here, but it's just a smoothing of the moving average and the MACD, the smoothed moving average and the MACD itself. And it's, again, as I said, it's the difference between the width of the two elements. The key point here, and you've probably picked it up already, is why do you need an indicator down here when you could just have the 2 moving averages up here? I often question the need for some indicators because they're not really it's not really adding a great deal of value. In fact, if you've got a chart like this, it's possibly simpler to use than a chart where it's got all this added data on there, and possibly data that can throw you off the trade. Anyway, I just thought I'd put that comment in there because it's quite key. Now, as I've said, the principles behind it initially was momentum and direction or trend, and this is what the indicator was initially designed to show. So you get the crossover, the MACD goes through the 0 line, or the 2 moving averages crossover, it becomes a bullish market. The earlier crossovers, I can show you down here, the earlier crossovers are much more aggressive. So where the MACD itself is crossing its smooth moving average, you'll see it's a very aggressive way of getting into the trade. So you could look to use it as an entry signal, but again, it flickers backwards and forwards sometimes and can get you in and out quite frequently. The principle is maybe take that as the first signal, and then the second signal is where it crosses later on. But the key thing with trading, and I'll say it here and I say it so frequently, is you don't need to be in at the very bottom. It's quite okay to be in up here and take a chunk of this than it is trying to catch the bottom. Maybe earlier on there may have been bottom showing and you're trying to get in down here somewhere, but I'll come on to that in a moment. So there we go, that's the trend-based method of using it. So the final part in terms of using the MACD, of course a lot of people use it for divergences. I'll show you the good and the bad here because it's a bit mixed in my mind. Like any divergence, it's depending on how you use it. So what we've got here is we've got a low come in on the price, and what we're doing now, instead of comparing the 2 moving averages, we're actually comparing price with the MACD itself. Let me just move that along. So you've got price there showing a low, a little new term low. It's just popped in there and put its MACD in. Price has popped up, come back down, but now the MACD signal has pushed up, so there's a divergence between. They're moving apart from one another effectively. So it's suggesting there's a divergence of trend potentially. Now on this particular occasion, you see we've got a crossover, so we've got another alternative option for this to give you a buy signal. You've got the divergence, you've got a buy signal, and not too much longer you've got the secondary, or the main signal, the bullish signal coming through here. So you've got signals coming through, and you've got, looking at price, you've got a higher low. So all of a sudden you've got a bundle of new things coming into play, which can say, well, that yes, at this point it starts becoming more bullish. Buying down here, yep, it can work, and it can give you an extra 30-40 pips maybe, but equally they can fail. So talking of failures, this is a good example of a good move. Talking of failures, and you don't have to look back too far to seeing the failures that sort of go on a strong trend. So when you move into strong trends, it's not an ideal strategy to be using it. How do you know you're in a strong trend? Well, you don't really know it's going to finish, when it's going to finish, so there's no absolute guidance. So psychologically, you've got to be prepared to take a number of losses to hopefully get those bigger wins. consideration here then is, or the point here is that the MACD hit the high there with the high, it pulled back, pushed back up, and you can see the MACD is lower, so the divergence across the highs and the lows there, so it's a divergence. At which point it gave the other sell signal there, the aggressive sell signal, or potential short bearish signal just there. But what happened to the price? Yeah, it came down a little bit, but largely it's been going up, and as it's been going up, the MACD was been coming down. Why? Well, it's flattened out a little bit, hasn't it? The price action's flattened out. Does that mean say it's going to roll over? Not really. It's flattening out around, making new highs all the time, giving us higher lows, higher highs as it's run through there. So the price action itself suggests there's still something in it. Yes, the momentum might be slowing through because of the lack of surges. It's more flatter and occasional surges. So yes, that market could be weakening from a price point of view, but if you're trading the divergent signal, there's loads and loads of them. That's not one, but there's one here. There's not so many crossovers at this point. It's just continue to get over. So if you're just waiting for the crossover as an addition, that might keep you out of some of these additional signals that are coming through on standard divergences. Okay, I hope you find that's very useful. If you like these videos, give me a thumbs up. If you're not already subscribing to my channel, please do. There's a button below, and I wish you all the very, very best. Bye for now.